Kia ora koutou. I'm Sean Davis, an Enterprise Advisor at Venture Taranaki, and you're joining us for another Ahead of the Curve webinar brought to you by Venture Taranaki in partnership with the Regional Business Partners Network. As of this week, Venture Taranaki have issued over $780,000 worth of funding that will be used towards professional services and advice. So please remember, if you need some support, please reach out to us. You can contact us through our website at business.taranaki.info. Today we have the rescheduled webinar joined by Ian Cooper, Warren Jones and Mike Miners from TSB. The focus is providing practical advice on how to strengthen your business and get the most from your banking relationship. Before we jump into the webinar, there's just a couple of functions to run through. So if you can please look at the bottom panel of your screen and look at the chat box. This is, if you click onto that, that's where you can interact with all the panelists and attendees. So make sure you click the function panelists and attendees. And then also to the side of that is a Q&A box. So if you just please type in all your questions into there, at the end of the presentation, we're going to get to those questions and the panelists can answer those. That's it from me. Over to you, Ian.
Thanks, Sean. Look, today, the team from TSB are going to talk to you about banking, your relationship with banking, and some of the insights, some numbers, and things we're seeing as we work through this COVID pandemic. We'll just start by having a look at some of the business support that's around at the moment. The government itself is providing two quite specific support for small medium enterprise. One of them is the Ird Loans. That's where a business can have up to $10,000 plus $1,800 per employee. And that's to keep you liquid, and there are still applications being taken at this time. And one of the other major things the government is doing to support directly is the wage subsidy. And while not everybody's entitled to the wage subsidy, it is still there for those that are struggling. From a banking perspective, there are two specific options of help that we can offer. There's three actually. One of them is that we can give you normal business as usual facilities and support. But if you're actually losing cash or have got no money as a result of COVID-19, we can change your, suspend your principal payments and put you on interest only for a period of up to 6 months. And the other thing we can do for you is, if it's really necessary, is defer your interest payments as well. Now that's a little bit like taking out new lending, so you've got to be careful. But for 6 months, we can defer your mortgage payments. The other thing that's happening is the government, in conjunction with the banking industry, have introduced a product called the Bank Finance Guarantee Scheme. Now, this is a government-launched product. It's specifically for small, medium enterprise, and it's to protect jobs and support the economy. It's Crown in partnership with the participating banks, of which TSB, BNZ, ANZ, ASB, Westpac, etc. are supporters of this. And it gives businesses with turnover up to $80 million, up to $500,000 over 3 years. Now, again, it's a loan, so you've got to think, how am I going to pay this back? But it helps with that liquidity crisis. The government's guaranteeing 80% of the risk, and the banks, we're covering 20% of the risk. So it's very much a partnership between the two. But at the end of the day, it is a loan to a business. The formal and normal lending process will be followed by the banks, which will make our own lending decisions. And these are at very favourable interest rates. And as an example, TSB are providing these at 2.5% per annum. So it is at the bottom end of interest rates. It's enough to keep the banks liquid. The purpose, the reason for these loans is to meet liquidity, urgent liquidity needs and bridging finance as you move through the COVID-19 effects. But what they're not able to be used for is capital assets, dividends, or on lending. So it is for your business, it's for the liquidity of your business. Now, who can get one of these loans? Well, the borrower must have turnover of less than $80 million, so it does cover a lot of businesses. You must be a New Zealand-based business. And this is a little bit more difficult, but you cannot have been on the bank's approved watch list, which is the naughty list, for want of a better term, as of January this year. And you cannot be have a material part of your business in what is called an excluded activity. And excluded activities are things like making munitions, so it's pretty definite. But there are some other parts of the economy that these loans aren't for, and property development and property investment are the most obvious ones. In recent times, it has been extended to include the agricultural sector, which we see as being fair, because not everybody's an exporter who operates in that sector. So farmers being able to access this is good news. So where are these loans being used? Well, the construction industry is one that really comes to mind, as 25% of all applications for this loan that we see are coming from the construction sector, and 45% by amount are going into the construction sector. Now, the construction sector wasn't showing any signs of weakness at the beginning of this, but as we've moved through, that's coming to the fore. And when I say construction, from my point of view, that also includes all the subbies, etc. But if we look at some of the banking support to the industry or industries over the last 3 months, banks have done business as usual loans for clients, 16,000 new clients at $10.3 billion. That's the banking sector as a whole. The bank finance guarantee loans, there's been 503 of those lent out at 86 million, but I think we're in the early stages of that. I think the need for those is still to come. The people who have gone interest only on their loans has been 13,000 at 12.5 billion, and deferred interest, compounding the interest, is 3,000 businesses at 1 billion. Now, that's a total of nearly 20,000 businesses have come and got some sort of bank support. But what we've got to remember is there's 500,000 little businesses and bigger businesses in this sector. So by far the majority have got the wherewithal to still continue to operate and operate well. If we look at some statistics around the bank finance guarantee scheme, about 25% of all inquiries, so say 100 people inquire, 25% actually need a loan. And of all applications, 75% of all applications at this point have been approved with only 4% decline, so there's not many declines going on. And the other interesting fact is that only about a third of all BFGS loans are for businesses who don't currently have bank debt. So you don't need bank debt to actually get a loan to continue and put liquidity into your business. Retail wholesale, that really started off as being what we thought was going to be the problem area of the economy. And as of today, but 24% by number and 24% by amount have been issued to those industries. Construction, as I say, 24% by number and a lot higher than that by amount. Accommodation, 16% by number, but only 9% by amount. So they're quite high in the need, but low in the amount required. So that's some of the support that's out there. We can give you interest only if required. We can defer your interest if required. And we all have access to the bank finance guarantee scheme if you qualify, and most businesses do. So what I want to just talk about now before I hand over to Mike and Warren is just what does a bank look for when we're dealing with a business, and how do we work out whether we can and should support you or not. Now, there's, in banking 101, we have what we call the 5 C's. And the 5 C's are character, cash, capital, collateral, and conditions. If we just have a quick look at collateral and conditions first off, collateral is what security we're going to take. If everything else fails, how's the bank going to get its money back? So we won't dwell on that. And conditions are, if we give you a loan, what are the conditions we're going to put around it with regards financial reporting, etc. So those ones we won't dwell on. What we will have a quick look at is character, how we assess that. What we're looking for in character is, will you do what you say you're going to do? If the going gets tough, as it is now, will you still front, or are you going to put your head in the sand? So that character is it's quite obscure in a way, because what we're saying is we're lending you this money in good times, and when things aren't quite so good, how are you going to act? And we look at credit ratings for that. We look at your past behavior at both our bank and other banks, etc. But that character one, it's hard, but it's something we spend a lot of time on. But I think the real important one here is cash. What we want to look at when we give a loan out is the sustainability of cash over the term of the loan. So will your business produce the cash that's required. And when you think about that, some businesses have really long working capital cycles, so you need a lot of cash. I mean, take boat building. You're building a boat, it could take 2 years to build it, so you don't get your money perhaps until it's sold to the person who's going to buy it. So you've got an awfully long cash cycle, and you need to fund through that. What we do see with some businesses is their cost of goods sold is higher than the amount they're selling it for, which isn't a very good business model. And some businesses just don't make enough cash to cover the wages, etc. And other businesses have leakage, whether it be theft, fraud, etc. So cash is the lifeblood of a business, and we spend a lot of time looking at the sustainability of that. And the third one of these top three is the capital. And this is one I feel over the last few years has been forgotten about. Capital is your strength of balance sheet. It is what you fall back on when times are hard. It is your fat. And what we see in this times, and it's really highlighted over the last 3 months, is that businesses that required help first often had no strength of balance sheet. Or if they had no strength of balance sheet, it was really bad, the banks are unable to continue to support because there is just no fat left in the system. So that capital is your strength of balance sheet, and it's what you survive on when things get tough. So just to reiterate, what do banks look at? We look at the character of the person, and there's ways to work that out through past financial performance, credit ratings, etc. And it's, are you going to do what you say you're going to do? There's the cash, the lifeblood of the business. Is it there today, and will it be there tomorrow? The capital, if that fails, have you got the ability to absorb losses? Collateral, how are we going to secure ourselves as a bank, because we've got a depositor who wants their money back, so we don't want to lose. And conditions, how we condition the loan, such as financial reporting, etc. So if we think about banking, that's what we look at, and that's how we decide how we're going to go forward and whether we should loan. And it's some of those things are very difficult at the moment with such a unknown outlook. But to bring some more practical view on all of this, I'll hand over to Mike.
Morena, thanks Ian. It's a really good synopsis of the support that's become available from government, and we can talk a little bit as well about what's become available from the likes of VT and the support that's come in locally as well, but also the context around how we as bankers and banks continue essentially to assess credit along the same lines as we always have. The fundamentals remain unchanged. What I'm going to talk to you a little bit about now is the relationship that I, as a commercial business banking manager, have with clients and how that relationship plays out, and a little bit about how you might position yourself for a meeting and the sort of things that we and other banks will expect in terms of preparation. Now, of course, we're all very conscious of the context and the backdrop that's got us into this position. It's clearly, in Grant Robertson's words, a 1 in 100 year event. Of that, there's no doubt. There's a huge amount of uncertainty, even as we've moved back into level 1, and that's in the form of supply chain, labour force, of course, and just general markets. And the impact of all of that is ultimately a change in both consumer behaviour, but also work patterns. And as property finance specialists, that's an area that we will continue to see a shifting transformation. And Jonesy's going to talk a little bit more about some of the insights that we're seeing both locally and further afield in that commercial property space. Bit of a snapshot though. Obviously, industrial is proving to be resilient, as those that are in that space, either as owners, managers, accountants of, or indeed tenants, anywhere that's been. If you can do your job from home, there's probably some impact. If you can't do your job from home, then it's a pretty good indication that you've got a safe investment. There's certainly some headwinds in office space, and Jonesy will talk a little bit more about that. Every day, we're starting to see more and more space becoming available. retail continues to face headwinds as well. So I'm going to talk a little bit about how banks and bankers have a key role to play in the recovery of this challenge, and keen to stress that that's not in an advisory capacity, but very much in a facilitation role. We're very much part of the wider economic ecosystem, an important part, I might add. But the key thing to understand is that whilst we lend money, we actually deal in risk. And in that sense, expect a reduced appetite in certain areas, such as residential development, commercial development in some areas, hospitality, accommodation, tourism, and I've mentioned retail property, will constitute sectors of the market where it may be more challenging to realise financial support from traditional financial partners than perhaps it has been in the past. We, as relationship banking managers, advocate on your behalf up through the credit line, so to speak, and understanding these challenges and how the process works will help us to make it easier for you. In that sense, and whether your stress is a desire to pass on some relief to tenants, whether you're experiencing interim cash flow challenges, whether, as Ian mentioned, weakness of balance sheet going into this, and it's fair to say that the economy was slowing going into COVID. We're all aware of those numbers. There have been stresses on certain business and industries' balance sheets going into this event. So there are likely to be challenges pre and because of and despite COVID. So don't please come to your bank manager, whether it be TSB or anybody else, saying, I have a problem and I need help. We need to understand what the challenge is, what has caused the problem, and what you're doing about fixing that problem, or what you have done. What is your strategy? How are you repositioning your business? How are you pivoting? Who are you engaging with? And what is needed from the bank? And how's the bank going to get its money back? If you can contextualize all of these challenges, then come to us with the information and say, I have a problem. These are the problems. This is what I've done about it. This is what I need from you. And this is how we're going to get you the money back. We will be far more empowered to support you and to provide options that will assist you in being resilient through this period and successful on into the future. We need to be confident that you're on top of the situation, and we need to be confident in your management of that situation. We want to see regular progress reporting, and that will certainly help to build confidence and makes it more straightforward, frankly, for us to be able to react quickly for you if we've got the information from you and we understand the context and the background of the challenge that you're facing. So what sort of actions can you take? And this is an area where prior planning and preparation really does stand to help with a successful outcome. As I say, we're not advisors, we're facilitators. So please engage with your trusted advisors, business partners, even that could include members of family or indeed your supply chain and customers. But it absolutely includes your accountants, your solicitors, and potentially a consultant. It may also include your industry and membership organisations, and those will be specialists according to your industry, or they might be more community-wide, such as the Chamber of Commerce or Borough, for example, who do an excellent job in advocating and collaborating on behalf of its members. Also, and I mentioned before, VT have done a really good job of grouping together the available local support and putting in place measures, and I'm sure Sean will talk more to you about what's available from VT later on. As part of all of that, Ian mentioned the importance of cash and cash flow forecasting. project over the medium term and just keep revising it. Focus on the cash flow preservation, but also it's really important to continue to act with integrity. Now, your 2018 and 2019 financial performance isn't necessarily going to translate into an income projection for the future. So do be realistic and do take on board the advice of those trusted partners, advisors, particularly your accountant, to potentially benchmark how your business projections maybe relate to others in a similar situation, industry or locale. But as I said at the top there, and Ian alluded to, the bank's debt servicing metrics and criteria remain unchanged. So it's important to engage with us to understand what that might look like and how realistic that performance might be. So the theme here all the time is engage early and keep talking. So the outcomes that we're looking for, and many of our clients and those operating in business, both locally and further afield, are going to continue to encounter significant challenges in the coming months. There is going to be a requirement for much restructuring of balance sheet debt and potentially business practices. And the reality is, from a banking perspective, that's going to significantly tie up what are already significantly strained banking resources. So the more preparation you can do prior to engaging or following that initial engagement, the better for you and for us. And it will, in the same way as keeping cash flowing around the system, will allow us to continue to allocate and prioritize our support internally, and that'll be the same for other banks. Speed is important, but understand that we have the same amount of resources to undertake quite a significant amount of work. And I will also add that AML compliance rules haven't changed as a result of COVID, so please do be understanding of information requests that we make of you. Help us to make you help you by making that information available and to meet those compliance obligations. That's really, really important. So the takeaway that I want to leave you with really is that we are absolutely here to assist as TSB and as a banking industry, and that's willingly, but we need your help to do so. And I'm now going to pass over to Warren Jones, Senior Commercial Manager, and Warren's going to talk to you a little bit about what we're seeing, some of the trends and aspects, and I'm sure there'll be some questions on some of what we've raised here, and look forward to answering those later on in the call. Thank you very much.
Good morning, everybody. Look, thanks very much for taking the time today to listen to what insights and what sort of advice we can hopefully give that does help. Thanks also Ian and Mike for the setting the background. What I'd like to do really is like Mike mentioned, is to put this into context and really go back to day one when we heard the announcement that the country was going into a lockdown situation, the unknown heading into something that was really a financial situation that even us who have been around for a while have never seen the likes of before. And it was an interesting scenario in respect to commercial property investors who the bank has a large exposure with and a large relationship with. These commercial property investors contain the likes of developers, investors in commercial, specialist type properties, hotels, motels. We also deal with hospitality and all those sorts of industries that make up part of our business. And drawing ourselves back to the first week of the COVID lockdown, certainly there was a mixed and varied response from our customers. Certainly we had situations whereby we had immediate requests for what is the bank going to do, how can the bank help, and work towards making the outcome as positive as possible for each of our individual customers. And initially, it was a little bit of a situation where we had to make sure that what we were understanding was what we knew our customers' industries were, how the impact potentially could affect them, and what the bank could do as the most viable and the most relative options. And we originally started to work through the process with minimal inquiry, but this picked up as tenants and landlords started to talk with each other and just realise the severity of where things were getting to. We had situations with tenants immediately advising that they were not paying rent, they weren't in a position to pay rent. I think we also had opportunists looking at deciding it was a good time for them to say they couldn't afford their rent either. So what we encouraged, and we always encourage with our customers, is to build an open relationship and making sure that we understand your business as well as you understand how we operate. So like I said, casting back, the situation was individual discussions with each of our customers, making sure that we were proactive in talking to them, understanding where they believe the pressure points were and what the potential concerns they had were. And as Ian mentioned earlier in the discussion, the three key things we came out with that I think were very successful in working with our customers were, again, dependent upon the structure that you have with the bank, but these included things such as deferring the principal repayments. This obviously rolled in line with cash flow. A number of the tenants in the properties that we had were looking to get reduction in rent rather than a full suspension of it. So we managed to work case by case around 3 to 6 month periods for assistance around principal suspension. And that basically then meant the loan was interest only and cash could continue to flow to service the interest cost. And that was monitored monthly against where the tenants were performing and with our customers. So that worked very well. Where we have customers or situations which have loans just on an interest-only basis, we deferred those interest payments. They were capitalised to the loan, ultimately increasing the debt that you owe the bank, but providing some immediate assistance in working through maintaining your other operating costs with a commercial property, as well as rates, power, all those sorts of things. So we worked through that. We worked through that process. And that was another good option in situations where, in some cases, tenants totally stopped paying rent. And again, that came down to the type of business that was occupying the property, non-essential tenants, hospitality, those sorts of tenants suffered immediately. So the combination of interest deferment and principal suspension was certainly an option that kept things ticking over for the customer in that regard. But equally so, where we had customers and clients that were in a situation with essential businesses operating, government tenants, it was business as usual. So the mix for us was really working through individually each of our customers' needs and how we could best maintain continuing to allow them to operate, but also allowing them to be able to pass on some of the assistance that we provided to their tenants, because at the end of the day, a commercial property's value is driven by its income. Its income is driven from its tenants. So if we are not working constructively to maintain a strong relationship across not only us with our tenant, but you with your tenant, us with you as the landlord, we were starting to see some hiccups. So really, I think where we've got to now, we've moved ourselves into stage one lockdown, I suppose you call it. What we have seen is that a number of the tenants are back in paying up their rent as originally contracted. So things are moving forward in a positive front. A lot of the assistance we have provided over the 3 to 6 month periods, the 3 month period now is coming short, and everything seems to be coming back to normal. I'm not sure that we have seen the carnage that we could see coming over the next 3 to 4 months. Government still has wage subsidies for certain businesses in place. they're operating. They're currently continuing to obviously consider what their structures are as viable going forward. Big costs in business obviously are wages, rents, those sorts of things. So the viability of how these businesses will be over the coming months, I think, is something that we're very keen to continue to monitor. But certainly, if there's one piece of practical advice that I would give anyone out of this whole COVID situation, is that the relationship is key. It's two-way street, in fact, three-way. I mean, the bank always prides itself on understanding your business, making sure that we fully understand what your needs, your strategies are. Relationships with your tenants are also very, very important, because at the end of the day, working with them is the key to being able to maintain a viable business for all three parties involved in a transaction. And I think over the coming months, we're going to need to continue to maintain that strong relationship and to understand just around what everyone's strategies are. The key in all this is not to bury your head in the sand. We are here to help as a lender. The last thing we want, probably like you, is surprises. So there are options available, and there is going to be some further fallout, I believe. We don't know where it's all going to lie at the end, but certainly I think as a bank, it's in our interest to work with our customers and support you and support them, and then of course that support flows downhill. So yeah, I think really moving forward, it's like I say, it's an unknown. It's unprecedented, as everyone seems to say. So we just need to make sure that we're around to support our customers and to move forward from there. So yeah, that's pretty much what we've seen as case in point, and I think we will continue to see further situations that we haven't seen before. But again, it's like I say, we're all here to support each other, and like I say, the relationship side of things is hugely important. So thanks for your time, and Ian, back to you.
Thanks, Warren. Thanks, Mike. So that's where we are in the industry. The banking industry is here to support you. TSB is here to support you, as are the other banks. There is a lot of government support and other support packages out there, whether it be the wage subsidy, the IRD loans, interest only on your payment deferred, and the bank finance guarantee scheme, amongst other things. The very, very uncertain future, and I think we all three of us talked to that it is really quite concerning, that we really, there's no consistent view on what the future does look like. So we are quite concerned, but we will continue to monitor. For you, engage with the bank, engage with your other professionals, etc. Engage with your suppliers, engage with your landlord. Remember, cash is the lifeblood of any business, so preserve your cash. Make sure you go and look for any leakages and stop them, and keep it in the system. So thank you, and over to you, Sean.
Great, thanks so much, guys. We've had a bunch of questions come through, which is really good. This is the first one here, and Mike, I think it kind of speaks to what you were talking about on information needed, understanding the challenges and the strategies that are going to solve that. But the first question here, what information on my business do I need to gather before coming to see my bank?
Well, I'm happy to talk to that. It's very industry dependent, and you will know from previous engagements as to a bit of an indication as to what might be required. But as a minimum, as I mentioned, we want to see a cash flow forecast. A bank will want to understand your financial performance from the previous year, whilst acknowledging that won't necessarily directly translate going into the future. But we need to be able to understand what your balance sheet position was going into this and how it has been affected by this, and what, as I said before, the strategies that you have evolving and what impact they will have on your forecast, and the revisions that you've undertaken on that forecast to reflect against the known information. So we're bankers, it's principally about financial performance and projection, but we'll also want to get a bit of a feel for how your strategy is developing, and again talk to those points around the management decisions and changes that you have made, so that we can understand how your business is positioning for the future. So I don't know if that necessarily answers the question. We could go into more detail in and around AML and compliance data, but that's probably more relevant to the specifics of your particular business and or industry. Your accountant and other trusted advisors will also be able to give you a steer and also the up-to-date information. We are only now 23rd of June, so a lot of the accountants will still be deep into preparing the 31st March 2020, so the last full financial year's performance data. We don't expect you to have fully completed financial information at this time of the year, but we would expect you to have management accounts or drafts to be able to give us a bit of a feel.
Okay, great.
If in doubt,
Sure. And leading on from, support and advice from your accountants, and I guess you've just answered this question, but will my bank manager support me pulling these documents together?
If it's information that we have accessible and available, such as account transactions, etc., naturally, but we will give you guidance as to what would be required. Obviously engage, explain what it is that you're looking to achieve and what support is required and what information specifically to that may be required. And each bank and or manager may have a different approach as to their own criteria or your industry or the depth of relationship or the recency of a lending event that may have taken place. So we may have up-to-date information. We may be in possession of that detail. We may not. So difficult to gauge. But again, your accountants will be able to give you that guidance.
Thanks for that. Another question came through. Other than a loan, what other business services can I expect from my bank?
That's probably you again, Mike.
So each bank will be different in terms of its capacity and the depth of services that it offers, and the relative information that they might have on your specific industry. If I speak to the TSB, we're a relatively small unit, and we pride ourselves on having in-depth, detailed knowledge and understanding of our clients' needs and what makes them special. So we would be able to, provide options from our suite of products and services that would best suit and allow us a situation, or be available in a given situation. But broadly, this is a cash flow challenge, and that requires cash flow support, and that really is in the form of short to medium term lending and an understanding as to how that is going to impact and position the business for recovery. So if it's areas outside of direct financial support, that's probably an area that is better suited to your trusted advisors and consultants and accountants.
Okay, great. You guys spoke quite a lot about some key trends that you've seen over the last 2 months. A question came through: what key trends are the banks seeing specifically in Taranaki?
So in Taranaki, the first thing we saw was the hospitality industry, the accommodation industry, and the retail industry struggle. And the cash flow issues came to the floor very, very, very quickly. And when the BFGS loan scheme was set up, the first probably 50 odd inquiries were directly from those industries. As things have moved through, those industries have got themselves sorted out. The wage subsidies come in, the IRD loan came in and was fine. Where we're seeing the movement to now is those industries that have a longer cash cycle. And that's perhaps why it's moving to the construction industry, where you think of a house and then, or a bigger building where you might have progress payments, but they're still a reasonable distance between. So those cash turnover type businesses have recovered quite well, but the industries where the cash flow is longer, the cash cycle is longer, are starting to struggle now. And they're usually the cash intensive ones, and when they've gone from lockdown to firing back up, the amount of cash required to set themselves back up is quite significant as well. So other than that, I'll say what I would say is that the economy, and I think it's to do with all the cash coming in the top from the government, the economy appears relatively sound, or remarkably sound. And yet what we're seeing going underneath and all what we're reading suggests that this isn't sustainable, and there is still some hardship to come. So what I would say, a trend, is that things are remarkably optimistic, but underlying, we can't quite see that.
I've got quite a specific question come through as well. I have a business loan and have noticed lower interest rates out there compared to my current rate. How do I understand if it's worth breaking my current contract?
How about you, Mike? You were dealing with one of these yesterday.
It is a consideration, and it needs to be done against the maths, and it'll be very specific. So it'll be a question of engaging with your bank, whoever that might be, to understand what those break fees will look like. Now, for context, a break fee, or sometimes referred to as early repayment interest, is what a bank charges to break a contract on a fixed rate of fixed term of lending, borrowing. The reason for that is the bank locks in its capital against your commitment, and if that is broken, then there is the chance, depending on what's happening in the market, that the bank could incur a loss, and it charges a fee in order to recover that loss. Now, engage with your bank, understand what that figure may look like, and what options might be available, and what savings could be involved in making that change. But again, there'll be some specific elements that will need to be considered in and amongst that.
Yeah, certainly over recent weeks, we have seen a number of a lot more people inquiring on this particular issue, but it does come down to the individual needs, what their cash flows are, and what their view of the future is. It's not really our view of the future, it's their own. So there's a lot goes into this, and I think it's something that they should take professional advice on as well.
Okay. And we've got room for one more question. So I'll just get you guys, and it's good if we could share this around. So we'll just get each of you to answer this to finish off. And I guess you've already answered it, especially Warren, talking about not burying your head in the sand and communicating. But is there just one good practice or tip you've seen from your clients or other businesses to get through their COVID-19 challenges?
Yeah, look, I'll take that to start. Look, I cannot stress enough communication. We have, as part of our property finance customer base, we have investors who have been around a long time, have been through hard times, have understood what it's like to work through situations that don't always play into your hand, and the communication being open with not only your bank but with your tenant or your landlord or whoever you are associated with in a relationship, whether it be as the tenant, as the owner, is to be open and upfront, and part of our role too is around the relationship side of things. The more we understand your business, the more we can understand a strategy to be able to understand where you're trying to get to and what you're trying to achieve, makes the whole process so much simpler. Like I say, don't bury your head in the sand. Don't be ashamed. This situation has come about not through anyone's fault, but we are here to work together to help you through it.
Be positive. Be realistic, and as exactly as Jonesy said, communicate and engage. But this is a team effort and it will require a team response, but a realistic one. And we're going to see some horrendous numbers on the 17th of September for this quarter's GDP. But we need to understand that that doesn't necessarily reflect the long-term reality. There will be some really good reasons to be positive. To all intents and purposes, we move out of recession next week into July, hopefully. So I'm positive, and I think everyone should take a positive attitude, but at the same time, be realistic and don't pay too much attention to the press.
Fair enough. I concur with the communicate, engage, and just more on a technical side of it. If you're good with your cash before, get better. And if you weren't good with your cash, learn how to do it properly, because cash preservation and cash management is one of the keys to getting through this. So thank you.
Thank you so much, Ian, Warren, and Mike. Thanks again. That was a really informative piece of information and super valuable for a lot of businesses out there. So this is going to be recorded and I'll email it through to all attendees. So make sure you share that to any of your database or customers or clients that you think could really benefit from that. Next time, so in a fortnight, we're going to have Tom Scher, and he's going to cover off energy, not time, is your greatest asset. So that's going to be on Tuesday, the 7th of July at 11:30 a.m. Thanks, everyone. Enjoy the sun and haere rā.
Thank you.